It was a down day for the U.S. stock market. In particular, small caps really got hit. Russell 2000 was down nearly 2% here today. This was definitely qualified as a risk-off type of a day, while there was some extreme differences among the 11 different sectors out there, with us leaning more heavily towards the defensive areas holding up very well today, whereas the more cyclical areas really did sell off. So we'll take a look at all of that, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a bearish trade on those small cap areas. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 20th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down to our description area and sign up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I'd encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that help support this project by clicking like and retweet on these Market Outlook related tweets. Last but not least, we do have a presence on Facebook as well. Feel free to join us at the web address you see listed in front of you. All right, let's go ahead and jump into today's activity. And as you can see, I've got chart 4B pulled up here in front of us. So let's kind of go through the numbers. S&P 500 was down 0.68% today. Dow Jones was down 0.75% today. NASDAQ Composite was down 0.92% today. And then the big whammy there, small cap Russell 2000 down almost 2%. It was 1.96% to be exact. And as you're looking at these three different charts, you'll notice that it is the Russell 2000 that looks quite a bit different than the others. You'll notice this really ugly candle we have off to the right-hand side here, representing today's big sell-off in the small caps. Not only was the size of the candle interesting to note, but also what it created on the chart, which is price is now below a falling 30-day moving average. Notice that moving average color changed from yellow yesterday to red here today as a result of not only closing below the moving average like it did yesterday, but today, because that pull down was so big, it actually negatively impacted that moving average. So now the new moving average is actually tilted a little bit lower there as well. Now, in addition to that, Russell 2000 does have a weekly bearish posture. Now, that's not necessarily new information. That already had occurred yesterday. Today, it just kind of continued in that same direction there. Even leading up to the last couple of days, we've been talking about pretty regularly here during these presentations that the Russell 2000 has been our lagging index. The question really was whether it would be drug up with all of the rest of the indices, or whether it would kind of go its own direction. Right now, we're seeing that it looks like it's kind of pulling the rest of the market down with it. Now, it's not violent, so we don't want to kind of go overboard with the analysis here, but there has been a couple of days in a row of downside action on the S&P 500 ever since hitting that all-time high here last week. And so Russell 2000, obviously its chart looks quite a bit different than the other three. In fact, some of you might look at this chart and it kind of looks like a bit of a head and shoulders pattern there. Of course, that is a bearish reversal type of a pattern that you'd be dealing with there. So without a doubt, this is a market that was kind of drifting a bit more towards some of the safer, maybe more high quality types of investments. In fact, one thing that I did notice here today, of course, today is Tuesday, and so it's the day that I teach my dividend growth investing class each Tuesday morning. It was interesting because our dividend growth investing class portfolio actually finished the day higher. We had more stocks in that portfolio up than down, and it was kind of the opposite effect of my Monday top-down trend trading class, where there the vast majority of the stocks we own in our class portfolio were down today. So without a doubt, it was a nod towards the dividend growth arena. For those of you that are dividend growth investors, as I am, these are the days that we somewhat enjoy. Now, we don't like seeing other people getting hurt with their investment portfolios, but this is the reason that we kind of lean upon the higher quality investments out there. I did pull up the Dividend Aristocrat list on our Market Watch Visualize tab here just to prove this out with the numbers, and you can see that we had one more stock in the Dividend Aristocrat list that was higher today versus the amount of stocks on the Dividend Aristocrat list that were lower today. So notice that there were 32 up, 31 down. Now, if you were to compare that to another index, let's go ahead and pull up, oh, I don't know, how about the S&P 500? Let's find that here. The S&P 500 wasn't nearly such a split decision. There you only had 184 stocks up, 316 down. I'm sure the NASDAQ 100 was probably even worse because this was a day where it felt like those high growth types of areas really struggled. And there you can see only 30 stocks were up, approximately 70 were down. And so not nearly the 50-50 split that we saw on something like the Dividend Aristocrat list. So it just kind of goes to prove out that point. Today was a risk-off day. This was a day where market participants were kind of drifting towards some of those higher quality areas. Stocks like Coca-Cola and IBM were up today, and usually those were kind of afterthought types of companies in recent years as growth stocks have been, reaching for the stars. But today was a day when those higher quality, old school types of companies did perform quite well. So where do we stand with the other three indices? We do continue to have our bullish posture on the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. You can see that with the green background colors there. And in all three of those cases, we do have the green line in the upper reversal zone, which tells us that whether the line is falling or rising, we would consider that to be strongly bullish posture territory. So, some of you might be looking at these labels and saying, well, wait a second, I think the green labels say that those lines are falling, and that is true. The lines are falling right now, but because they remain above 80, we kind of give them that grace period to kind of waffle around a little bit there between 80 and 100 and still be willing to call them uptrends. And I think that makes sense. If you were to look at the chart of the S&P 500 here, I think most people would identify that as an uptrending security, and therefore having a bullish posture there tends to make sense. One thing I do like to kind of look at if we have a day like today where we've got a sell-off, and especially if we followed it up with yesterday's sell-off as well, is whether we have any bullish intermediate confirmation signals, because they are a little bit more prevalent on days like today. But as I'm looking at these charts right now, the answer to that's actually no, believe it or not. We got close in a couple of cases, but we just didn't quite close there. And part of the reason is because at the end of the day, we did have a bit of a rally going into the closing bell. So you'll notice that all of these candles have a little tiny shadow on the bottom of their side there. What that identifies is that little wick, or that shadow, however you want to describe that, will represent that we didn't close at the lows of the session. And so the bulls did find some attractive prices and did push us off of the absolute lows of the day. And in doing so, kind of removed those otherwise confirmation signals that would have existed. Remember, the confirmation signal is when the red line ends in the lower reversal zone on a day when the green line is considered bullish. So the red momentum line on the S&P 500 is at 22, it's at 23 on the Dow Jones, and it's at 24 on the NASDAQ Composite. So all of those were awfully close to 20, but just didn't quite close below there. Had we closed at the lows of today's session on all three of those candles, I think we probably would have had some bullish intermediate confirmation signals. So keep your eye on that. It's possible we might end up with that tomorrow. And so maybe some, kind of nice buy the dip opportunities could start emerging there. Not to say that there aren't areas of the market that already have that possibility. For instance, a lot of the recent IPOs and recent SPACs that have been issued, many of those stocks are down 30, 40, 50% in the last month or so. So some areas of the market are really getting worked over right now, but the broad markets that we tend to focus our attention on with kind of the more blue chip types of companies, they're still holding up reasonably well at this point. Let's go ahead and take a look at our next chart, which we will look at the three green arrows setup. And this will be chart 4D. And as we're looking at this here, you'll notice that we don't have three green arrows on any of these charts. We do have three red arrows on the Russell 2000. Down below here, you'll see we've got red arrow number 1 on the moving average, red arrow number 2 on the MACD histogram, telling us we've got a loss of momentum. And then arrow number 3, red arrow number 3 on the stochastics, basically giving us an indication that we're closing near the lows of previous ranges. Those are generally considered more bearish. Now you look at this chart and it's not necessarily terrible. We don't have, a series of lower highs and lower lows. We largely have a sideways pattern on this chart right now. But on a relative basis compared to the other three charts that we see, it is true that the Russell 2000 small cap index remains the laggard of this group. The other three charts have a mix of green and red arrows, and so that's noteworthy, I guess, and timely, because today was the day when it basically lost its three green arrow status. And in all three of the chart's cases, it was as a result of the MACD histogram. Notice we got a red arrow right there on the S&P 500, another arrow right there on the Dow Jones, and then the other one on the NASDAQ composite. And so that signifies a loss of momentum, and that makes sense after a couple of days of selling that we've seen here, kind of rolling over off the top. So while the uptrend, the series of higher highs and higher lows has not been wrecked or ruined on the S&P 500, we do see a bit of a loss of momentum that's taking place there. But, that's not a reason to necessarily sell. It's just something to be aware of. For instance, we had red arrows back here and here and here on the S&P 500's MACD histogram, and that was just telling us a moment in time where that uptrend rolled over to form yet another higher low. And so that could very well be in the cards here once again on the S&P 500. Maybe we go down for another week or so. We start finding a bottom around that rising 30-day moving average, and then who knows, maybe in a month we might be back to all-time highs yet again. And we'll look back at this moment where we lost momentum and say, you know what, that might have been an interesting opportunity to buy the dip. So we'll keep our eye on that story, but right now we should make the assumption that this uptrend is still in place. The 30-day moving average continues to be tilted higher. We continue to trade above that rising moving average on the S&P 500, which is the most widely tracked equity benchmark on the planet. So while it is important to note that the small caps are struggling here, remember the Russell 2000 is not as important as the S&P 500. So right now you kind of have to say that those are offsetting to a degree. We remain bullish on the S&P 500, even though we've got some bearishness there on the small caps. Let's go ahead and take a look at our 1040 crossover method now, and this will be chart 4C. As we're looking at this, one interesting thing to note as of today is we do have a red arrow showing up on the Russell 2000's chart. Now what that signifies on this chart's perspective is that price has fallen below the 10-week moving average here. Remember, the real thing we're looking for on this chart setup 4C is whether the moving averages themselves are crossing over. And in this case, it would be the 10-week moving average in orange, the 40-week moving average in blue. And in all four of these charts, we're not even close to having a crossover to the negative side yet. Remember, this type of thing takes a long time because we're using weekly candles here. So there's no threat of any sort of moving average crossover taking place. But if there is to be one at some point, let's say later in the spring or early summer, then we might look back at this time and say, yeah, that might have been those early, footprints in the sand, so to speak, when we saw that red arrow emerge when price was below that 10-week moving average. But like I mentioned before, it's going to take a lot of work because there is a lot of separation between that orange and that blue line. Remember, the Russell 2000 was in a very powerful mode at the end of 2020, and so that's when you start seeing these moving averages really separate away from one another, and we are a long ways away on the PPO from crossing that zero line down below. So anyway, I don't want to make it sound like, hey, there's a everybody's screaming fire in a crowded movie theater or something like that. That's not this situation here. It's just be aware of it. We're pointing it out because it's happening on the chart. And so it's just one more thing to consider as we're looking for our trades out there. Otherwise, the other charts continue to look pretty reasonably fine. You will see that the NASDAQ does look like it's kind of rolling over a little bit here on the PPO. It's not very evident. Let me right click and go to maximize the chart here. You can't see it that well with a visual eye there, but there is a tiny rollover on the PPO. In other words, this while the orange line went up last week, the blue line may have gone up a little bit faster. So maybe from that perspective, it's kind of a better way to see the pinching than seeing a drastic move lower in the orange line to create that. And because this is a lagging indicator, right, in the case of the orange line, a 10-week moving average, and the blue line, 40-week moving average, this needs to kind of get sorted out over time. So I wouldn't read too much into any 1 week signal to begin with, but just something to keep on your radar there. Otherwise, Dow Jones and the S&P 500 still look pretty strong from that perspective. Let's pop on over to the internet here briefly. I always like to get an opportunity to say thank you to those of you that help support the Market Outlook videos. You can see that 103 of you clicked like for me there on Twitter the last time I did the video, and therefore I'll be happy to give you a full-length version, including the trade application example here in tonight's video. So if you want that to continue, do your part to click like there for us. That's all we ask for you out of these videos, even though they soak up about 2 or 3 hours out of our time to do these free videos. So if you guys continue to support them, we'll continue to do them. But clearly, if you've got better things to do, so do we. So we'll figure that out through the liking process there on Twitter. But thank you to all of you excellent market scholars out there helping to support this project for David and I. Also, one thing that I just got done wrapping up with here a moment ago was putting together some of the numbers for my factor-based swing trading class that I'll be holding tomorrow morning like I normally do on Wednesdays. And there was something noteworthy to point out, and that is momentum slipped back down to the last place position on the factor selector. The last couple of weeks it had gone up to second to last, but we've had a struggle with a lot of those momentum types of companies here recently, and so that has worked its way back to the bottom level here once again. This is a far cry from where we were at in most of 2020. Remember, most of 2020 was a momentum market. Momentum was number one for the biggest chunk of that year compared to these other factors that are on the board. So it's a little bit abnormal now, seeing over the last couple of months, that blue kind of line down below there is either at number 5 or number 6 here, meaning that momentum is either last or second to last for the last couple of months here at this point. So this is not new information that momentum has struggled. This has a continual problem that we've identified and try to take advantage of in my factor-based swing trading class. Remember, in that class, we look for bullish setups out of value stocks, and we look for bearish setups out of momentum stocks. And so we look to short sell companies and things like that in that particular class if you're interested in joining me for that tomorrow morning. The other thing I would note is that who momentum replaced at the bottom there was low volatility. And today was one of those days where low volatility did shine quite nicely. And so it'll be interesting to see if that can kind of get a little giddy up and go here in coming weeks and months, because like momentum, low volatility has struggled. Now, a lot of that has been the interest rate sensitivity story. A lot of low volatility stocks are your utilities and your REITs. And with interest rates surging since the beginning of the year, those types of stocks have struggled on a relative basis. But those of you that have been watching the interest rate environment closely enough here in the last week or two know that things have reversed a little bit there. Interest rates have actually fallen a little bit, and therefore maybe given the low volatility stocks a little bit of life there, a little bit of wind in their sails. So keep your eye on that potential story there as well. Let's get back on over to the Thinkorswim charts and do some 12 grid analysis here, starting with the chart 5A, which will be our asset class 12 grid. And remember, the background colors of these charts will tell us whether we're bullish or bearish using the market forecast technical indicator. And if we have a pink background color, those are bearish posture charts. If we have a green background color, those are bullish posture charts. And so let's start in the lower right-hand corner here, since I had just mentioned it a moment ago, and there is something noteworthy to mention today. This is the 10-year U.S. Treasury Yield. So like I mentioned just a moment ago, for most of 2021, we have been in a rising interest rate environment. That is something that has really helped financials, and it has really hurt utilities and REITs on a relative basis. But right over here on basically March 30th, we topped out in the interest rate environment, and we've really been in a bit of a mini downtrend since that moment in time. And while it hasn't necessarily fallen back to drastic levels, it has been an important enough fallback where we have actually seen an impact on the 30-day moving average itself. Notice today the 30-day moving average is now red. That is the first time on this chart. Let me right click and go to maximize sell here. You'll notice this is the first time we've had the red moving average on this chart going back full 3 months. In fact, it might even be longer than that. Let's go back 6 months and just take a look at it there. Yeah, this is a 6-month chart. This is the first day in 6 months, a half of a year, when the 10-year U.S. Treasury yield has been trading below a falling moving average. That is a really long time for kind of a macro concept like 10-year Treasury yield in this case. Let's go back a little bit further. Eventually, we will see a red moving average, I have no doubt, but how long ago was it? It was back here basically at the end of September of last year. That's how far back we would have to go to see a situation where the interest rate environment was below its own falling 30-day moving average. So this is important to recognize. I think we kind of had this assumption for a while that interest rates were just off to the races and we would never look back. Well, guess what? We're looking back now. Where this takes us is anybody's guess. We're still a long ways away from these lows of last year, but you never know when that negative momentum will kind of feed upon itself. So that is something that we want to keep our eyes on. It does impact other asset classes. As I mentioned earlier, you're going to have your interest rate sensitive areas like utilities and REITs do a little bit better in this type of an environment where we do see interest rates falling now all of a sudden. Another chart in the other corner here, in this case the US dollar, also has a red background color along with a red moving average. So the US dollar has been weak in the last 2 or 3 weeks and has sliced straight through its moving average. It was actually up today, and so worth noting that we haven't had many up days with the US dollar in the last few weeks. Today was one of them. And when the dollar is up, oftentimes US stocks can outperform foreign stocks, and we did see that today. You can see the S&P 500, while being down, it was only down 0.73%, whereas foreign stocks from a developed perspective really took a hit here today. They were down 1.79%. Emerging market stocks were down just a little bit more than the S&P 500, down 0.81%. Of those 3 charts up there, it is the emerging markets one that still looks the weakest to my eye, but it is worth noting that we now have a green moving average on EEM, which suggests that price is now above a rising moving average. It's not rising a lot, but it's rising a little bit. There's a little bit of a turnaround that's starting to take shape right there with the emerging markets. So keep your eye on that story as well. Down below here with the commodities, we kind of had a bit of a split day. With a rise in the US dollar, not a huge surprise to see oil prices down, particularly since this was a bit more of a risk-off type of a day, as I mentioned before. Oil is a little bit more of a speculative, risky asset that does better when, cyclicals are firing and, the economy is strong and things like that. So today was a little bit of a give back day there in oil, but gold was kind of viewed as a bastion of safety of sorts here today. Remember, the last time I did this market outlook video on Thursday, we put that philosophy to work in a bullish gold mining trade idea at the end. So happy to see gold still holding up here today despite a pretty ugly day for a lot of the other portions of the financial markets. Gold was up about 0.36% today. You can see that gold continues to have that bending higher 30-day moving average, which is colored in green, in addition to having a strongly bullish posture here. So will be interesting to see where that takes us. And remember, over the weekend, there was a bit of a mini crash in Bitcoin. You can kind of see it on this chart over here. We had this big gap down because this chart, I think, is an index that kind of looks at it from a business days perspective. But remember, cryptocurrencies are actually trading on Saturday and Sunday, and there was a bit of a crash on Saturday where you had this big spillover in Bitcoin prices. So it's kind of interesting to note that gold is firming up at a time when Bitcoin is selling off a little bit there. Sometimes there's that trade-off effect that kind of takes place in traders' minds where one is better than the other during different market environments. One thing that we talked about in my dividend growth investing class today was inflation and how there's been a number of stocks that have come out, Coca-Cola, Procter & Gamble, Kimberly-Clark, Corning, a number of them saying that we're raising prices of our products and services because our input costs are going up. And so it's going to be interesting to see if maybe gold can benefit under that inflationary type of environment going forward as well. Let's take a look at our sectors here now. Chart 5C will be our sectors 12 grid. And so as that's pulling up, you can see we've got mostly green background colors telling us that we have bullish intermediate postures, but there is one that kind of stands out here. Pretty ugly chart off to the right-hand side here with energy. Not only has it been ugly, right? This is not new information, and we've been talking about it in this video for the last 2 or 3 weeks that we've been trading below the moving average. But today is noteworthy in that energy has broken a fairly significant support level. You can see we had a bit of a double bottom from March 23rd and April 13th. That we had approximately the same lows that we were dealing with there. Well, today we sliced straight through there. That was a pretty ugly day on XLE. It was down 2.65%. We actually closed below that breakdown zone as well. Although we didn't close at the low of the session for XLE, we did close below where that kind of prior support level would have been. And so we're seeing a little bit more of a crescendoing effect of selling taking place here. We've already had the red moving average on XLE since dating back to April 8th. So, this is we're 12 days in on this move at this point, but it's not looking any healthier as time goes on. Sometimes, a move kind of it expends itself and it's ready to kind of revert back the other direction. But right now, this thing seems like it's kind of picking up more steam as the days go on. And so we got to be a little bit more cautious and careful around those energy securities there. Areas that did well today. Interestingly enough, and I was tweeting about this earlier today, so some of you probably caught this as well, but if you were to look at this 12 grid, notice that it is the 4 bottom charts that are the only 4 on the board that closed in the green. And that's not really a coincidence. When I set up this 12 grid, I set it up specifically for that reason. That bottom rung there is meant to be our defensive areas of the market. So healthcare was up 0.39% today. Remember, healthcare was breaking out of that kind of reversal pattern that I had pointed out last week and has continued to burst higher. So any of you that bought that breakout from over this high back here on January 26th, you've had 4 straight up days off of healthcare there. So another nice day from healthcare. Consumer staples were up 0.55% today. We actually covered the consumer staples in depth in my dividend growth investing class earlier today if you're interested in that particular sector. So feel free to check out that recording. It is available on our calendar on our website for those of you that are Plus and Premium members of Market Scholars. Utilities also up over 1% today. Both the utilities and the staples are our 2 overweight sectors right now in my dividend growth investing class. So we've been happy to see both of them emerging from the ashes here in recent weeks and kind of starting to take on a little bit more of a leadership type of a role. Take a look at utilities intermediate line right now is at 97 all of a sudden, and we're clearly at multi-month highs there. And then last but not least is real estate, which was up 1.11% today. And again, take a look at that chart. That is a beautiful trend right there from real estate. It may not have the most impressive types of growth stocks within it, but because they were beaten up so badly in 2020, many of them had a lot further higher to bounce up. And so we are seeing that move take place right now as we start working our way towards an economic reopening here. So interesting to note that we had a clean sweep from the defensive sectors here today to the upside. All of the other sectors, the more cyclical and secular sectors, they were all down here today, with energy being the worst of the lot, down 2.65%. So anyway, this was, again, to reiterate, a risk off, gravitate towards dividend growth types of companies here today. In fact, that's another thing we could look at, come to think of it, is on our market segments graph. We don't pull this up all that often, but it's 5.0 for those of you that are following along at home that are premium members. Notice in the lower right-hand corner here, we have dividend yield and dividend growth. Those are two slightly different concepts there. There's a lot of overlap, I'll grant you, but this is a time where it is healthy to note that dividend growth investors, which is that philosophy that I practice myself and try to teach all of my students, is a leading area right now. Notice that dividend growth right here is basically right there at a all-time high. The last 3 days basically all kind of touched an all-time high at around the same level. On the other hand, if you look at dividend yield just to the left, notice that we actually have a pink background color telling us that we've got a weekly bearish posture. It's not nearly anything terrible to look at. So it's not like high beta as an example. High beta stocks are really getting trashed here and really slicing through that moving average. Dividend yield is rolling over a little bit, but remains just barely above that moving average. But the difference that stands out to my eye is dividend yield did not eclipse its high from back here on March 15th, whereas dividend growth has continued to work its way to the upside. We saw some impressive dividend growth announcements here more recently. I was tweeting today about Johnson & Johnson, a company that has more than 60 years in a row of dividend increases. They raised their dividend yet again here this morning. We saw Travelers come out with a dividend increase announcement, and then Advance Auto Parts had a massive tripling or quadrupling of their dividend here today as well. So some interesting news items developing there in the dividend growth world. And if that's something that excites you the way that it excites me, I of course would invite you to join me in my Tuesday morning dividend growth investing classes. We've been seeing a lot of success there. And in fact, I was just telling my students this morning that out of all of those portfolios that I've built over the last 6 years, I don't recall a time when we've had as many double-digit percentage winners representing such a big chunk of our portfolio. I think it's more than half of our current holdings are double-digit percentage winners, and we've bought all of them just within the last 3 or 4 months. So whereas a lot of other styles are really falling off the map right now, kind of the growthier and more cyclical areas, we are finding a lot of success in the quality dividend growers that are out there, and I know a lot of you are benefiting from that as well. All right, let's get into our trade application example. It's going to be a pretty basic one here today. I'm going to come over here to chart 3A, and we'll pull up ticker symbol IWM. This is the Russell 2000 ETF. So remember that what we were looking at earlier in this session was the RUT itself, which is the index for the Russell 2000. This is the ETF where you can trade that index, IWM. And wanted to pull up this chart to kind of help you see it a little bit more clearly here, that it does appear that we've got a bit of a head and shoulders pattern taking place on this particular security right now. And a head and shoulders pattern in this case, if we were to break that neckline down below, would be considered a bearish reversal type of a trade. While we don't know for sure that that's going to happen, it's starting to give us the impression that it wants to perform that, because it's forming its right shoulder here with its left shoulder over here and its head kind of here in the middle. So it's not really gaining any steam. You know, you had a couple of days there where it was questionable. It made it look like you were going to make a move higher, bounce off that moving average. But here in the last couple of days, it's been a little bit more emphatic that this is a bit more of a bearish chart than maybe some people want. And so this is one that I'm going to be playing to the bearish side of the equation. Remember, I've already sent out the trade confirmation details and all that to those of you that are premium members via our Telegram app. These trades are done during the market session. So that way you guys can have access to this information prior to other people that will consider it overnight during the free video. But anyway, what I ended up doing was selling what's known as a bear call spread, where I sold the $228 call and I bought the $230 call for the May monthly time period. And so this blue line that you see on the chart here represents where my break even is on that particular trade. In other words, this is a moderately bearish trade. What I want to have happen in this case is for this security not to go up and above this blue line by the middle of May when the contracts expire. As long as that is the case, I will make money off of the credit that I received up front when I sold that bear call spread. So it's a way to say, you know, not necessarily that you are going to step on the gas require that this security go down at a rapid pace. Instead, you're giving yourself more flexibility here. Now, remember that the upside rewards are not as great either, but you are giving yourself higher probability chance of being correct, because naturally a number of things could happen with IWM between now and the middle of May. It could go down and kind of complete this head and shoulders pattern, and in which case our bearish trade would do fine. Well, if it doesn't do that and it just goes sideways, this bearish trade will do fine as well. It could even go up. We just don't want it to go up a whole lot. We don't want it to go up $10 per share and cross up through this blue line. And as long as it goes up, but goes up moderately, we can still win this trade. Where we lose is if it were to rip higher. But right now, that is not the expectation. You can see that all of our lines on the market forecast are pointing lower here. Falling, 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 falling. All four of those colored labels say falling in them, telling us that we've got some bearishness in the system. You can also see that the small caps have easily underperformed the S&P 500's dotted line here, in addition to the other things that I pointed out earlier, which is we have a bearish near-term posture, bearish intermediate posture, and we also have a red moving average suggesting that price is below a falling 30-day moving average there. So all those things kind of line up for more of a bearish trade opportunity in this particular case. And again, the details are there for those of you that are premium members in the Telegram app. All right, that's what I had for you here today. Interesting day, one that definitely leaned towards kind of a risk off mindset, where the kind of more defensive areas of the market held up much better than the more cyclical areas of the market. So, don't fall asleep on some of those dividend growers out there that have started to perform a little bit better here more recently. So if you got value out of tonight's analysis, do me one favor. Just click like for me there on Twitter if you want a full-length video again on Thursday. As far as I know, David should be back in the saddle with you guys tomorrow, and then I'll look forward to seeing you later on in the week. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.